Hey everybody, it's your boys Seth and Paul for Everything Money Channel. Welcome to the new year 2021. We are here in Mexico. Your boy Paul, your lover, your uncle, your confidant, your consigliere, Paul.
I think we need to show this view, Seth.
But we're both staring almost window to window at the Pacific, and it's incredible. We're here on this new year to analyze stocks as we always do. And
all investments.
All investments.
I want to do more real estate this year.
Yeah?
Absolutely.
We know that you guys love stocks, but we do know that some of you love real estate. And if you love both, you can check out our Patreon, which we will talk about later in the video. But in this video, we're going to talk about steel dynamics. You are going to learn about the financial analysis, the financial health of this company to see if their stock is a buy or an avoid. We're not going to look at the stock price and which way it's going. We're going to look at what they're making, their revenue, their PE, all of the numbers right now through our 8 build process.
Fundamentals, as they say.
But first, we appreciate an early thumbs up. Pretty please just tickle that thumbs up button. We greatly appreciate it. Paul, why don't we get to it? Tell us about Steel Dynamics.
Well, first off, you literally told me the stock, 2 minutes ago?
Yes.
And I said, I've never heard of Steel Dynamics. So,
and guys, here's the point. And that's a great point, Paul. Don't write in the comments, why would you guys do a video about something you've never heard about? We don't care. If the company's financials are good, Paul, and it's a healthy company, half the time we both own stocks sometimes. I own stocks and companies. I don't even know what the hell they do, but it's undervalued. Go on, Paul.
The point of the 8 pillars is people sit there and say, well, don't you know anything about the company? The point of the 8 pillars is it's a high level view to say, do I need to go learn more about the company? Do the financials make enough sense where now I'm going to go sit there and take my time to go understand the business, the industry, the competitors, etc. You guys all think, let me go understand that stuff first. I disagree. My method is let me understand the numbers first, and the numbers make sense. It's kind of like this. When you're looking for a house, do you sit there and say, let me find the house with the pool, the blah, blah, blah? No, you sit there and here's my budget. My budget's $300,000. Great, now what do you want? I want this, and you're not gonna find that. Okay, that's my whole point. I'm looking at the numbers first, then from there, deciding what qualitative aspects does the company have that would make me want to buy it.
This company's been requested off our Patreon, so let's do it. Steel Dynamics, Paul, go ahead.
They're a scrap-based steel mini mill with roughly 13 million tons of annual steel production capacity located in Indiana. And Seth has his cheat sheet because he still doesn't remember the 8 pillars in order.
That's right. Pillar number 1 is...
Well, let's first look at market cap. It's roughly $8 billion. That's not a pillar. It's just for us to know the price of the company because $8 billion is our price. We don't care about the stock price. We care about the market cap of the company, which is the number of shares outstanding multiplied by the stock price. So if you wanted to buy the entire company right now, it would cost you about $8 billion.
Pillar number 1 is PE ratio of all the price to earnings.
16.5. So we're at a check mark there because we want under 20 as a starting point.
Pillar number 2 is profit margin. We want this above 10%. Uh-oh, Paul.
4.3%. So it's low. That's not a good thing or a bad thing. It's just something we have to understand. And one thing to also keep in mind, they pay about a 2.7% dividend. So let's say to be conservative, they spend about $200 million a year on dividends. So we want to understand if their cash flow can support that. So we have 1 check for PE, 1X for profit margin so far.
Pillar number 3 is revenue growth over the past 5 years, Paul.
So you look here, 7.6 billion, 10.4 billion. So it's a check mark there, but keep in mind, from 18 to 19, it fell $1.4 billion or so. That's a big drop, but either way, it's still a check mark.
Pillar number 4 is profit growth, Paul. The same thing. We want the profit growing over the past 5 years.
So 5 years ago was their only year in the last decade where they lost money. That was 130 million. And last year they made 670 million. So definite check mark there.
Pillar number 5 is shares outstanding. We want the number of shares going down.
Check mark there, 242 million down to 220 million roughly.
That's pretty good.
Yeah, that is pretty good. That's almost a 10% decrease in the number of shares outstanding.
Pillar number 6 is current assets greater than current liabilities.
So remember, current assets is basically the cash on hand. It also includes inventory, but things that can be easily converted into cash. $3.9 billion. And their current liabilities are the bills that are due in the short run, short term, 1.176, check mark there.
Really
and
good. Keep going.
They have $3.8 billion in cash basically, and they only have $4.5 billion in total liabilities. So they almost have enough cash and inventory to pay off all their debts completely, which is a big thumbs up there.
That's good. The final, not the final, but pillar number 7 is free cash flow growth. This is cash from operations minus capital expenditures. And Paul, tell the viewers why this is so important.
Why don't you tell us why it's important, Seth?
Well, the free cash flow, folks, that's going to be the money they have that's going to, you really like this because it,
what are they going to use the cash for?
They're going to pay out dividends. They're going to make acquisitions, Paul.
They're going to buy back shares.
They're going to, well, they are. They're going to buy back shares.
Yeah, they use the free cash flow to buy back shares a lot of times. So I look at free cash flow over net income because that's the actual cash in hand. Net income can be manipulated in multiple ways to show different numbers, but free cash flow is harder to manipulate. Still, you can manipulate it, but it's harder to manipulate free cash flow than the other metrics. It measures actually the cash coming in, and it's cash from operations less their capital expenditures, and the capital expenditures is the money they invest into their property, plant, and equipment, which would probably be a pretty good number for a steel mill. They're probably going to invest a lot in their steel mills.
So we want this number going up over the past. We want the free cash flow to be obviously increasing and getting better. Then we'll take the average, and our pillar number 8 is we'll find the price to free cash flow. So let's look at it, Paul.
Okay, so 5 years ago they had so if you remember 5 years ago they lost money in net income, but they had free cash flow of around $950 million. This year they have free cash flow of $950 million, roughly. So it's technically a check mark. I'm going to give it a check mark, and the reason being, if you look at their capital expenditures over the last 5 years, 115, 200, 165, 240, and it jumped up big time. So part of what we want to do here is we want to understand, this tells us a story. Why did their capital expenditure all of a sudden increase? This is part of the analysis you need to do after you like the financials. You sit there and say, okay, why did they suddenly start increasing their capital expenditures? Is there some new plant they're building? Is there some big expansion that's going to drive revenue and profit? You need to understand these things to understand how does the company allocate their capital. Does that make sense, Seth?
Yeah, let's look at the average free cash flow.
Okay, so you have those two numbers. Then we're going to put in 650. Then we're going to put in 580. Then we're going to put in the final number of 180.
Oh, growth. Okay, 80. Divided by 5. This is the average free cash flow over the past 5 years is 860, Paul.
Now, this is a steel business, commodities driven. The reason I don't look at commodities business so often is it heavily relies on the commodity price for the businesses.
Keep going, Paul.
So when the commodities prices are up, their revenue is going to be up, their profits going to be up. When commodity prices are down, revenue is down, profits down. So that's why I like the average. Now, for a company like this, I want to be under 15 times free cash flow, and well under that. And guess what? We are.
Go on.
Because the company is currently valued at $7.8 billion. The company is currently valued at $7.8 billion, and their average free cash flow was $860. That is about 9 times free cash flow. That is awesome. So we want to look at this in further detail. And they're paying about $200 million in dividends. They can easily afford that. They can easily afford that dividend with their free cash flow. I think this is a company, Mo, let's take a look at Steel Dynamics, STLD. They're currently selling for 9 times free cash flow.
Trader Mo is behind us. He's on our live streams, which are Tuesdays and Thursdays at 1 p.m. Join us for your on-demand questions. Paul, it's not often we find a stock that you like. Steel Dynamics reaches some of your pillars, not all of them, but you're in love with that price to free cash flow. Yes,
but if you now share my screen with me. Great. Now you look at their income statement over the last 12 months. Their revenue went from 10.5 last year to 9.35 in the last 12 months. So revenue is definitely down, probably because of the economy. And a company like this will be hurt in the economy. That's why you want to pay a low multiple of free cash flow. If we hit a recession, a bad one, this will be hurt the most. So let's look at the free cash flow now over the last 12 months as well. Their free cash flow over the last 12 months has been, wow. They have a big, in the last 12 months, they went from an average of $300 million in capital expenditures to $1 billion in capital expenditures. So we want to understand why they spend a ton of money on capital expenditures. This is not necessarily a bad thing. It's just something we have to understand because that is a big, big number. So I still want to look further into this company, but based on the recent information, we want to understand why they're doing what they're doing. This is why I sit there and tell you guys, I don't care about the business side of it yet. Look at all the questions I came up with immediately just from looking at the financials. The financials and the 8 pillars tell me a story. And that story needs to then we have to go out and find the answer to that story. If the answers are great, if that $1 billion in capital expenditures was, yeah, we're building a huge plant that's going to increase our business capacity by 20%, and we have found that we're under providing for our customers, awesome. What's the bottom line going to be, et cetera? Then you can sit there and do some analysis and determine, hey, listen, they're investing $1 billion this year, but it's going to increase their profit by $300 million a year. Boom. At 15 times PE, that's $4.5 billion in value. Go spend it. Do you see what I'm sitting there saying? Like, this is all part of the analysis that we need to do as we're analyzing this company. is looking at how we sit there and look at what their plan is and what their financials tell about the story.
So from what you gathered, Paul, look at the stock price. What do you like? I mean, where are you buying this? I mean, to bring it all home, what do you like about the current price of the stock, and where would you like to see it?
I listen, if the story on the $1 billion in capital expenditures is good, I'm buying it at this price. But I've got to understand more about the story about what the company is doing. They spent a lot in capital expenditures. That's something we have to understand fully. They went from spending $300 million a year to $1 billion in the last year. Why? They still had free cash flow, by the way. If you notice, they still had free cash flow in the last 12 months, but it just barely enough to pay their dividend. They had about $250 million in free cash flow. That's barely enough to pay their dividend, but they're still paying it. And it looks like they increased their dividend recently. So good stuff.
If you like what you hear, if you like this in-depth analysis, you're not going to see on this channel us chasing down hype stocks. Half the time we talk about companies
that I don't even know.
We never heard of, and you probably haven't either. But the goal of investing is to buy low, underpriced companies that can certainly grow. So if you like what you hear, join our Patreon, patreon.com/everythingmoney. The description is below. Paul, 200 members on our Patreon talking to like-minded people. Trader Mo is a specialist at this, and he said that he just loves the community that we're putting together and growing, where you can throw ideas off each other. You can ask people literally from all over the world and ourselves our thoughts on companies, and make yourself some money. So, Paul, I appreciate you. Go ahead, Paul.
All this data you see.
Go on, Paul.
All this data you see on Y charts cost me $500 a month. I went and paid $30,000 a year to get this data from Morningstar to create our webpage that you'll be able to get all this data from. And as long as you're a Patreon member, doesn't matter what level you're at, the $8, $25, or $100 level, you will get this all for free if you're a Patreon member once the website comes out. But you have to be an active Patreon member to get it for free.
Make sure you're smashing that thumbs up. We appreciate it. We love you guys. And we appreciate your support. Paul, 10,000 subscribers is so close. It's incredible.
We're maybe 3 days away from it.
Love you guys. Thanks so much. See you.